I am Charlie Munger. I am dead now. But before I died at 99, I spent over 7 decades mastering the art of not being stupid with money. And what I am about to tell you is going to make a lot of very wealthy people in Manhattan and Greenwich very, very unhappy with me. But here is the thing about being dead. I don't give a damn. So let me say this as clearly as I know how. The financial services industry has been systematically lying to you for decades. And that lie, that beautiful, insidious, perfectly legal lie, has cost the American public somewhere north of $3 trillion in unnecessary fees over the past generation alone. That is not my money we're talking about. That is your money. Money that should be compounding in your retirement accounts. Money that should be funding your kids' education. Money that should be buying you freedom and dignity in old age. Instead, it is buying vacation homes in the Hamptons for people who've convinced you that investing is so impossibly complicated, so dangerously technical, so bewilderingly sophisticated that you need to pay them 1% or 2% of everything you own. Every single year, just for the privilege of their expertise. It is asinine. It is legalized theft, and I am going to expose exactly how it works. Now, I need to warn you if you are currently paying a financial advisor to manage your money. What I am about to tell you is going to hurt. You are probably going to realize you've been getting fleeced, maybe for decades. That is going to be uncomfortable good. Discomfort is the beginning of wisdom, and you are going to need some wisdom, because what I am teaching you today is how to keep more of your own goddamn money. Let me tell you how I learned this lesson back in the 1960s, when Eisenhower was still a recent memory and men wore hats that actually fit. I was practicing law in Los Angeles. I was making decent money, not wealthy yet, but comfortable enough to start building an investment portfolio. Like most people who don't know any better, I hired a broker. This was a fellow at a major Wall Street firm. I won't name them, but let's just say their reputation was impeccable. He came highly recommended. Other lawyers used him. He spoke the language of high finance. He had access to research reports that ordinary mortals supposedly couldn't get. He was, in other words, exactly the kind of impressive-sounding charlatan that the financial industry specializes in producing. This fellow would call me. This was back when phones had cords and you couldn't screen your calls. And he'd tell me about this stock or that stock. Charlie, he'd say, I've got some research here that suggests we should move your position in XYZ Corp. Or, the momentum indicators are telling us it is time to take profits on ABC Industries. Momentum indicators, technical analysis, a sophisticated portfolio rebalancing. All this language that sounds so intelligent, so professional, so scientific. It was all complete horseshit. But I didn't know that yet. So I did what he recommended. I bought, I sold, I traded. I paid his commissions on every single transaction. And after 2 years of this professional management, you know what happened to my portfolio? Nothing. I'd made maybe 3%, 4% total over 2 years. This was during a period when the overall market was up considerably more than that. I'd underperformed a simple index by a wide margin. But here is what really opened my eyes. I sat down one evening, I still remember this. I was in my study, probably had a drink, and I calculated exactly how much I'd paid this fellow. All those trades, all that sophisticated portfolio management, all those momentum indicators, over $7,000. Now, $7,000 in 1960s money was real money. That was a new car. That was a year's tuition at a good university. That was more than many families earned in months of hard work. And what had I gotten from advice that had generated essentially zero returns for me? but it had generated guaranteed income for him. That is when I understood. This wasn't a flaw in the system. This was the system. The whole apparatus was designed to extract fees from me regardless of whether I made money or lost money. In fact, in many ways, it was designed to make more money when I did things that hurt. I hired him the next day, never worked with a financial advisor again, managed all my own money for the next 60 years. Became a billionaire. Coincidence? I don't think so now. Before you think I'm just telling you that all financial advisors are evil people, consciously trying to steal your money. Let me be clear. That is not the lie I am exposing. Some of them are evil, of course, but most aren't. Most are perfectly nice people who believe they're helping you. The lie is much more subtle and therefore much more dangerous. The lie is that their interests are aligned with yours, that they make money when you make money, that you are on the same team, that they're working for you. They're not. Let me explain the incentive structure, because most people, even smart people, even successful people, don't understand how they're being played. When you work with a typical financial advisor, they make money from you in several ways. The most common is the assets under management fee, usually 1 to 2% of your total portfolio value, charged only 1%, they'll say, a small price for professional management. They'll say, let me show you what that small 1% fee actually costs you. Because this is where the magic of compound interest, which should be working for you, instead works against you. Say you have $500,000 invested. You are paying 1% in fees. That is $5,000 in year one. Not too painful, right? But now project that out 30 years. Assume reasonable market returns, let's say 8% annually, which is roughly the long-term average. If you kept that 1%, your $500,000 would grow to approximately $5 million. If you pay away that 1% every year, you end up with about $3.7 million. That small 1% fee just costs you $1.3 million. $1.3 million. That is not a rounding error. That is your children's inheritance. That is your financial security. That is your freedom, gone, transferred from your pocket to theirs, in exchange for what I am going to tell you what, usually nothing of value. But it gets worse. Oh, it gets so much worse, because many advisors don't just charge you that 1% management fee. They also make commissions on the products they sell you. They'll put you in actively managed mutual funds that charge another 1% to 1.5% in fees and pay the advisor a kickback. They'll sell you insurance products wrapped in investment vehicles, variable annuities, indexed annuities, all this complicated garbage that generate massive commissions for them while locking up your money and generating mediocre returns for you. Now you are not paying 1%. You are paying 2%, maybe 2.5% or 3% in total fees when you add everything up at 2.5% annual fees. That $500,000 over 30 years becomes about $2.4 million instead of $5 million. You just gave away more than half of what should have been yours, more than half. And here is the really insidious part. All of this is technically legal. It is disclosed somewhere in the fine print that nobody reads. But it is fundamentally corrupt because it creates a system where the advisor profits from giving you advice that may or may not be, and usually isn't, in your best interest. Let me give you a concrete example of how this works in practice. Your financial advisor can recommend one of two things. Option A, an actively managed mutual fund that charges 1.5% in annual fees and pays the advisor a nice commission. Option B, a low-cost index fund that charges 0.03% in annual fees and pays the advisor nothing. Which one do you think they're going to recommend? Obviously, they're going to recommend option A, and they'll justify it with sophisticated sounding language about active management, professional stock picking, beating the market, tactical asset allocation, all this impressive terminology. It all sounds very intelligent, very professional, and it is almost always complete nonsense, study after study. And I am talking about comprehensive academic research done by people with no axe to grind, has shown that over long time periods, roughly 90% of actively managed funds fail to beat simple, low-cost index funds, especially after you account for fees. 90%, but financial advisors keep recommending these high-fee products because that is how they get paid. They're not working for you. They're working for themselves, and you are paying for the privilege of getting advice that makes you poorer and them richer. This is the lie. This is the fundamental corruption at the heart of the financial services industry. Until you understand this, you are going to keep getting fleeced. Now, why is this so hard for brilliant people to understand? Why do smart, successful professionals keep falling for this? Because the financial services industry has spent billions of dollars perfecting the art of making you feel incompetent. They know what they're doing. This isn't accidental. They've deliberately created an environment where investing appears impossibly complicated, dangerously technical, bewilderingly sophisticated. Turn on CNBC. What do you see? Flashing numbers, tickers scrolling. Multiple people shouting over each other about the Fed, about interest rates, about sector rotations, about volatility indices. It looks like the cockpit of a 747. It feels overwhelming. And that is the point. They want you to feel overwhelmed. They want you to think, this is too complicated for me. I need professional help. But here is what I am going to tell you. And I need you to really hear this. Investing is not complicated if you avoid doing stupid things. In fact, successful investing is almost boring in its simplicity. Buy good businesses or broad market indices. Hold them for decades. Don't trade frequently. Keep costs low. That is it. Everything else, all the technical analysis, the sophisticated strategies, the active management, the tactical allocation, is just expensive noise designed to generate fees. Let me prove this to you with actual data, because data doesn't lie. People lie. Advisors lie. Marketing lies, but data doesn't lie. If you had simply put your money in a low-cost S&P 500 index fund and held it for 30 years, let's say from 1990 to 2020, you would have beaten roughly 90% of professional money managers over that period. 90% of professionals, people with MBAs from Harvard, people with decades of experience, people with teams of analysts and sophisticated computer models and access to company management. You would have beaten 90% of them by doing absolutely nothing except buying an index fund and ignoring it. And you would have saved hundreds of thousands of dollars in fees that you would have paid to those managers for the privilege of underperforming. You didn't need special knowledge. You didn't need sophisticated analysis. You didn't need professional advice. You just needed to not be stupid. And unfortunately, paying a financial advisor is often one of the stupidest things you can do with your money. There was a study done, I believe it was in the early 2000s, that compared the returns of thousands of individual investors who manage their own money versus those who use financial advisors. The results shocked a lot of people, but they didn't shock me because I'd been saying this for decades. The individuals who managed their own money generated higher average returns than those who paid for professional advice. How is this possible? How can amateurs beat professionals? Two reasons. First, the self-directed investors weren't paying 1 to 2% in annual fees. They kept more of their returns. That alone accounts for a massive difference. Second, and this is crucial, the self-directed investors tended to keep things simple and trade less frequently. They bought index funds or solid dividend, paying stocks, and just held them. They didn't have an advisor calling them every quarter suggesting their balance, or take some profits, or rotate into defensive sectors. The investors with financial advisors, on the other hand, were constantly having their portfolios churned, buying and selling, moving money around, generating fees and commissions and taxes, all of which destroyed their returns. The professional advice was worse than no advice at all, because the advice was designed to generate fees, not returns. This is the dirty secret of the financial services industry that nobody wants to talk about. In most cases, you are better off on your own than paying for advice. Now you might be thinking, Charlie, surely there are some situations where I actually do need professional help, right? Fair question, let me address it. I am not saying that nobody should ever use financial professionals. That would be stupid. And I am trying to help you avoid being stupid. What I am saying is that 95% of people don't need ongoing financial advisory services and shouldn't be paying for them. So when might you actually benefit from professional financial help? If you have an extremely complex situation, if you own multiple businesses across different jurisdictions, if you have complicated estate planning needs involving trusts and multiple generations and minimizing estate taxes, if you have sophisticated tax situations requiring planning across multiple states or countries, then yes, you might benefit from hiring specialized professionals. But notice I said specialized professionals, not a general financial advisor. You want a tax attorney for tax planning. You want an estate planning attorney for estate work. You want a certified financial planner for specific planning questions. And here is the key: you pay them by the hour for their expertise, not a percentage of your assets. You don't give them ongoing control of your money. You don't pay them 1% every year regardless of whether you are getting any value. You hire them for specific tasks, you pay them for their time, and then you move on. This is how you should think about professional financial advice, as something you buy when you need it, not as an ongoing service that you pay for forever. For most people, and I mean the vast majority of people, your situation is not active. If you are a professional making a good salary, accumulating savings, investing for retirement, your situation is actually very straightforward. Even if it feels complicated to you, it isn't. Here is what you need to do. First, maximize contributions to tax-advantaged retirement accounts. 400 WUNC. IRA, whatever you have access to. Max them out. The tax benefits alone are enormous. Second, invest those contributions in low-cost, diversified index funds, total stock market fund, maybe some total bond market fund as you get older. That is it. Nothing fancy. Third, hold those investments for decades without touching them. Don't try to time the market. Don't panic when things go down. Don't get greedy when things go up. Just hold forth. Keep 6 months of expenses in cash for emergencies. High-yield savings account, boring, safe, liquid. Fifth, avoid debt, except for a reasonable mortgage on a house you can actually afford. That is it. That is the whole strategy. You don't need a financial advisor to tell you this. You don't need sophisticated planning or complex products. You need discipline and patience. And those are things you can't outsource to someone else anyway. Let me tell you what I actually did with my own money over the decades, because I think it illustrates the principles I am teaching you. After I fired that broker in the 1960s, I never worked with a financial advisor again. Not once in 60 years. I managed all of my own investments, made all my own decisions, and I became a billionaire. Now, obviously, I had some advantages. I worked closely with Warren Buffett. I had access to opportunities that most people don't have. I am not suggesting you can replicate my exact results, but the principles are exactly the same. Whether you are investing $50,000 or I invested in businesses I understood. I held for very long periods, decades, not quarters. I didn't trade frequently. I didn't try to time the market. I didn't pay fees to middlemen. Simple, disciplined, patient. That is what works. Warren has a term for this. He calls it sit on your ass investing. And he is right. The less you do, the better you'll probably perform. Because every time you do something, every time you trade, every time you rebalance, every time you respond to some news story or market movement, you create an opportunity to make a mistake and you generate costs and fees and taxes. The best investors are lazy investors. And you can be a lazy investor without paying someone 1% of your wealth every year to make you lazier. Let me make this extremely concrete so you understand exactly what I am talking about. Let's say you are 40 years old. You have $200,000 saved. You earn $150,000 a year, and you can save $30,000 annually going forward. Scenario 1, you go to a financial advisor. They charge you 1% annually. They recommend a portfolio of actively managed funds that charge another 1% on average. Total fees 2% per year. Over the next 25 years until you are 65. With reasonable market returns, you accumulate about $1.8 million. Now scenario 2. You do it yourself. You put that same money in low-cost index funds charging 0.05% in fees, no advisor, no active management, just index funds, same market returns, same time period, same contributions. You end up with about $2.7 million. That is $900,000 more. Almost $1 million by doing it yourself with simple index funds. $900,000 that the financial advisor and the mutual fund companies would have extracted from you for providing essentially no value. That is not a theoretical number. That is real money. That is your retirement security. That is your children's education. That is your freedom. And all you had to do to keep it was avoid paying someone to give you advice you didn't need. Now, let me systematically destroy the specific lies that financial advisors tell to justify their fees, because understanding these lies will help you resist them when you hear them. This is the most common justification. They'll tell you their professional stock, picking their research capabilities, their sophisticated strategies can generate returns that beat simple index investing. Therefore, their fees are worth it. Complete nonsense. The data, and I am talking about decades of comprehensive academic research, shows that over any meaningful time period, the vast majority of active managers fail to beat the market, especially after fees. Over 15 years, over 20 years, over 30 years, the longer you look, the worse active management performs relative to passive index funds, even among the small percentage that do beat the market in any given year. Very few can do it consistently. It is basically random, and the ones that do succeed are almost impossible to identify in advance. So paying for active management is paying for a service that statistically doesn't work. You'd have better odds in Vegas. At least in Vegas, they give you free drinks. Financial advisors love to talk about asset allocation, balancing different asset classes, correlation coefficients, efficient frontiers, modern portfolio theory, all this complicated sounding academic language. And then they'll tell you that creating a properly diversified portfolio requires professional expertise. More nonsense. Diversification is important. I am not denying that. But achieving adequate diversification is trivially easy. You can buy a single total stock market index fund, and you immediately own a piece of thousands of companies across all sectors and sizes. Boom, diversified. Want to add some bonds. Buy a total bond market index fund. Now you are diversified across stocks and bonds. Congratulations. You just built a properly diversified portfolio in about 5 minutes with 2 funds. Cost maybe 0.05% in total fees. You didn't need a financial advisor. You didn't need sophisticated analysis. You didn't need to pay 1% every year. But that simple solution doesn't generate revenue for the financial services industry. So they pretend it is inadequate, and you need something more complex that they can charge you for. When markets get volatile, financial advisors like to talk about how they're actively managing your portfolio, moving to defensive positions, reducing equity exposure, protecting your downside. It sounds good. It makes you feel like you are getting value for your fees, like they're doing something to earn their keep. But market timing doesn't work consistently. Nobody can reliably predict when markets will go up or down. Let me tell you what happened during the 2008 financial crisis, because it perfectly illustrates this lie. I knew dozens of people who had financial advisors, and during the worst of the crisis, late 2008, early 2009, when the market was down over 50%. You know what most of those advisors recommended? Sell, move to cash, protect what is left. And their clients did. They sold near the bottom, locked in massive losses. And then they missed the subsequent recovery when the market came roaring back. Meanwhile, the people who didn't have financial advisors, who just held their index funds through the crash because they didn't know any better or because they trusted that markets eventually recover, those people ended up much better off. The professional advice destroyed wealth. Did nothing, literally sitting on your ass, was the better strategy. This lie is particularly insidious because it contains a grain of truth, which makes it more believable. It is true that individual investors often make emotional mistakes. They panic during crashes. They get greedy during bubbles. They chase performance. And advisors say they provide value by preventing these mistakes, by being the steady hand. But here is the reality. Financial advisors don't actually prevent emotional mistakes. They're human too. They have the same biases, the same emotions, the same tendencies to panic or get greedy. The real solution to emotional investing mistakes is education and a plan. If you understand basic principles, if you've committed to a long-term strategy, if you've accepted that volatility is normal, you don't need to pay someone to keep you from panicking. You just need to stick to your plan, and that costs nothing. All right. I've spent the last 30 minutes explaining why financial advisors are, in most cases, a waste of money. Now let me tell you specifically what you should do instead. You don't need to become an expert. You just need to understand a few fundamental concepts. What are stocks and bonds? How do they generate returns? Why does diversification? How does compounding work? Why does time in the market beat timing the market? You can learn all of this in a few weeks of reading. I'd recommend a few books. The Little Book of Common Sense Investing by Jack Bogle, A Random Walk Down Wall Street by Burton Malkiel, and yes, some of what Warren and I have written about investing over the years. These aren't complicated books. They're written for ordinary people, and they'll teach you everything you need to know to invest successfully on your own. I cannot emphasize this enough. Simple beats complex almost every time in investing. Buy low-cost index funds. If you want to keep it incredibly simple, just buy a target date retirement fund from Vanguard or Fidelity that matches when you expect to retire. These funds automatically adjust your asset allocation from stocks to bonds as you age. They charge very low fees, typically around 0.1% or less. That is it. You are done. You don't need individual stocks unless you really enjoy researching companies. You don't need real estate investment trusts or commodities or cryptocurrency or any of the other complicated garbage that advisors will try to sell you. Just broad market index funds held for decades with consistent contributions from your income. This strategy is boring. It won't give you interesting stories to tell at parties, but it works better than almost anything else you could do. Set up automatic contributions from every paycheck. Set up automatic investment of those contributions. Set up automatic rebalancing once a year if you need it. The less you have to think about it, the better you'll do. Because every time you think about your investments, every time you check the balance, every time you read a news story about the market, you create an opportunity to make an emotional mistake, automate it, forget about it. Let compound interest work for decades. This is what wealthy people actually do. They build systems that work automatically. Then they focus their time and energy on earning more money or doing things they enjoy, not obsessing over their portfolios. If you have specific questions, estate planning, tax optimization, insurance needs, hire a fee, only financial planner, get your answer, move on. This might cost you a few $100s for a consultation instead of thousands or tens of thousands in ongoing advisory fees. And the advice is often better because the planner has no incentive to recommend complex products. They just answer your question, you pay them, done, let me end with this because it is the most important thing I can tell you. The biggest lie financial advisors tell you isn't really about investing at all. It is a lie about who you are. They tell you, either explicitly or implicitly, that you are not capable of managing your own money, that you are not smart enough, not educated enough, not disciplined enough, that you need them because you can't do it yourself. This lie is particularly effective because it taps into people's insecurities, their fear of making mistakes, their imposter syndrome, their anxiety about money. But it is not true. You are capable of managing your own money. You don't need special expertise or credentials or insider knowledge. You just need to learn some basic principles. Keep things simple. Be patient and avoid paying unnecessary fees. If you are smart enough to earn a good living in your profession, whether you are a doctor, a lawyer, an engineer, a teacher, you are smart enough to invest your own money. Don't let the financial services industry convince you otherwise. Don't let them extract decades of fees from you for services you don't need. Take control of your money, educate yourself, keep it simple, and you'll end up far wealthier than if you pay someone else to do it for you. That is the truth they don't want you to know, but now you know it. What you do with this knowledge is up to you.